Ever wondered how Warren Buffett picks his winning stocks, or how professional investors separate the diamonds from the rough? Here's a mind-blowing fact. The average investor checks stock prices daily, but less than 20% actually read the financial statements behind those prices. Today we're diving into the world of fundamental analysis, the art and science of understanding what makes a company truly valuable. Grab your calculator and let's decode the financial DNA of businesses. Welcome to your comprehensive crash course in fundamental analysis. Think of this as learning to read a company's report card, but instead of grades in math and science, we're looking at revenue, profits, and cash flow. Here's the thing. While technical analysts stare at charts and patterns, fundamental analysts dig into the actual business performance. It's like the difference between judging a book by its cover versus actually reading the content inside. By the end of this video, you'll understand the 3 essential financial statements that every serious investor needs to master. Plus, we'll explore some real-world examples and common pitfalls that even experienced investors fall into. Next up is the balance sheet. Imagine taking a photograph of everything a company owns and owes at a specific moment in time. This is where we see the financial foundation that supports all those income statement profits. Assets, what they own. This splits into 2 camps, and the distinction matters more than you might think. Current assets, the quick-to-cash stuff. Money in the bank, inventory they can sell this year, and bills customers will pay soon. Here's what to watch for. If a company's inventory is growing faster than its sales, that could signal slowing demand or poor inventory management. It's like a restaurant buying too much food that might spoil. Long-term assets, the heavy hitters, buildings, equipment, patents, and other things that create value over many years. Property, plant, and equipment tell you how capital-intensive the business is. A tech company might have minimal long-term assets but huge value in intellectual property, while a manufacturing company needs expensive machinery to operate. Liabilities, what they owe. Again, 2 categories that reveal different risk profiles. Current liabilities, bills due within a year, employee salaries, supplier payments, short-term loans. The key ratio here is current assets divided by current liabilities. If it's below 1, the company might struggle to pay its short-term bills. That's like having $500 in your checking account, but $800 in monthly expenses due. Long-term debt, the marathon obligations, mortgages, bonds, and other debts that stretch over multiple years. Here's where debt analysis gets crucial. Some debt is good. It allows companies to grow faster than they could with just their own cash. But too much debt can crush a company during economic downturns. Shareholders' equity. Here's the magic number. Assets minus liabilities equals what actually belongs to the owners. It's like your home equity, but for an entire business. Growing shareholders' equity over time usually indicates a healthy, profitable business. The beautiful thing about balance. Here's a practical example. Imagine 2 retail companies. Company X has $100 million in current assets and $120 million in current liabilities. They might struggle to pay suppliers. Company Y has $100 million in current assets and $60 million in current liabilities. They have financial flexibility. Which would you rather invest in? Finally, we have the cash flow statement, the most honest financial statement of them all, and frankly, the one that separates amateur investors from professionals. Companies can play games with reported profits, but cash doesn't lie. Operating cash flow. This shows the actual cash generated from running the business day to day. It's like tracking the physical money flowing through a lemonade stand. Not promises of future payments, but real cash transactions. Here's why this matters so much. A company can report profits on the income statement by booking sales they haven't collected yet, but operating cash flow shows what actually hit the bank account. If operating cash flow is consistently lower than net income, that's a potential warning sign. Investing cash flow. Here we see cash spent on or earned from investments, buying new equipment, selling old assets, or acquiring other companies. Usually negative for growing companies, and that's often a good sign. It means they're investing in their future. But pay attention to the details. Are they buying productive assets like new factories, or are they just acquiring competitors at high prices? There's a big difference between smart growth investments and empire building that destroys shareholder value. Financing cash flow. This tracks money flowing between the company and its investors or lenders, issuing new stock, paying dividends, borrowing money, or paying down debt. This section tells you how the company funds its operations and growth. A mature, profitable company might show negative financing cash flow because they're paying dividends and buying back shares. A growing company might show positive financing cash flow from issuing new stock or taking on debt to fund expansion. Free cash flow. The golden metric, it's operating cash flow minus necessary capital expenditures. This represents the actual cash a company can return to shareholders or reinvest for growth. Warren Buffett calls this owner earnings, and for good reason. Free cash flow is what you'd pocket if you owned the entire business. It's the cash left over after paying all expenses and maintaining the business. Companies with consistently strong free cash flow can weather economic storms, pay dividends, and fund growth without borrowing money. Here's a real-world scenario. Company A reports $100 million in net income, but only $60 million in operating cash flow because customers are slow to pay. Company B reports $80 million in net income and $90 million in operating cash flow because they collect cash quickly. Which business would you rather own? Company B's cash flow profile is much stronger. Here's where fundamental analysis gets exciting and where most people make critical mistakes. These three statements work together like a three-dimensional puzzle, and you need all three pieces to see the complete picture. The income statement tells you if the business model works. Are they making money? But that's just the beginning. The balance sheet reveals the company's financial strength. Can they weather storms and fund growth? A company might be profitable but drowning in debt, or losing money but sitting on a mountain of cash that gives them time to turn things around. The cash flow statement shows the reality behind the numbers. Is the business actually generating cash? This is where financial engineering gets exposed. Let me give you a powerful example of how these work together. Imagine a software company reporting 50% revenue growth and healthy profits. Sounds great, right? Sounds great, right? But dig deeper into the balance sheet and you might find that accounts receivable, money customers owe them, is growing even faster than revenue. Then check the cash flow statement. If operating cash flow is weak despite strong profits, this could indicate the company is booking sales to customers who may never pay. Smart investors read all three together and look for consistency. The best companies show growing revenues, expanding profit margins, strong balance sheets with manageable debt, and robust cash generation. When all three statements tell the same positive story, that's when you found a potential winner. Conversely, red flags appear when the statements contradict each other. Profits without cash flow, growing sales with deteriorating margins, or rapid growth funded entirely by debt. These mismatches often predict future problems. So how do you put this into practice? Start with companies you understand and use every day. Analyze their financial statements and see if their financial performance matches your experience as a customer. Professional investors use these statements to calculate ratios, compare companies within industries, and spot trends over time. They look for consistent revenue growth, improving profit margins, manageable debt levels, and strong cash generation. Here's your homework. Pick a publicly traded company you're familiar with. Maybe it's the retailer where you shop, the bank you use, or the streaming service you subscribe to. Download their latest annual report and work through each statement. Ask yourself, does their financial performance surprise you? Does it match what you know about their business? Remember, fundamental analysis is both an art and a science. The numbers give you the facts, but understanding what those facts mean in context requires practice and business judgment. Start simple, be consistent, and over time, you'll develop the intuition that separates successful investors from the crowd. Fundamental analysis won't make you rich overnight, but it will make you a dramatically smarter investor. In a world where AI and algorithms dominate short-term trading, understanding the underlying business fundamentals gives individual investors a sustainable competitive advantage. Remember, behind every stock price is a real business with real financial performance. These three statements are your window into that reality. Revenue tells you about market demand, profits reveal operational efficiency, and cash flow shows the ultimate truth about business quality. The most successful investors, from Warren Buffett to Peter Lynch, built their fortunes by understanding businesses better than the market does. With these fundamental analysis skills, you're well on your way to joining their ranks. What company would you like to analyze using these principles? Drop your suggestions in the comments below, and don't forget to subscribe for more investing education that cuts through the noise and gives you actionable insights. Ready to take your analysis to the next level? Check out our video on financial ratios to learn how to turn these raw numbers into powerful investment insights. And if you want to see fundamental analysis in action, watch our complete breakdown of a real company's financial statements. Until next time, keep learning and keep investing wisely.